So welcome. My name's Stuart Patch and I'm a CFO and I also work as a financial educator as well. And here we're looking at the fourth session in a series of understanding ratios and company performance. And today we're going to focus on the financial structure of the organization. So there's going to be four key outcomes that we'll have a look at today. Firstly, how to assess the financial structure of the organization. We'll then have a look at some of the key ratios to understand how we can assess that financial structure. And then we'll be having a look at how does that affect the returns for shareholders and also how can it affect the risk profile for the organization. So if this sounds of interest to you, please sit back and let's go. Now, before we get going, if you're not familiar with financial statements, please have a look at this little video clip here. It gives you a quick overview of those financial statements and will make a lot of the terms that we use in this session more understandable. So as we dive into these financial structure ratios, the first one we're going to focus on is the debt to equity ratio. So now the debt to equity ratio looks at exactly what it describes. What is the proportion of debt and the proportion of equity within the organization? And this assesses the company's financial risk in terms of having more debt becomes a more risky organization. The second ratio we'll have a look at is the debt ratio. And this achieves a similar purpose, but more specifically is looking at the proportion of assets of the organization and how much of those are financed by debt of one form or another. A third ratio we'll have a look at is the equity ratio. And with this ratio, it's almost the inverse of the debt ratio, and we're looking at the percentage of an organization's assets that are financed by equity. And the higher this ratio, then the stronger, the more solvent the organization is considered to be. So the last two ratios that we'll have a look at are looking at how well can we service our debt. Firstly, we'll have a look at the interest coverage ratio, and this is looking at how well can we cover our interest payments from our operating profits. And of course, the higher this is, the lower chance of default that there is. And then the last ratio is the debt service coverage ratio. And in this ratio, we're also adding in the principal repayments for the organization. So we're looking at how well from operating profits can the organization cover its interest and principal repayments. And again, that's assessing the higher that is, then the less chance there is of default. Now, before we dive into those ratios, let's have a look at what the effect of the financial structure can have on a company's results and shareholders' returns. So here, let's consider two identical companies, Company A and Company B. Both are financed with $2,000 and Company A is $2,000 of equity, so that's all been put in by its owners, whereas Company B has $2,000 of $1,000 of debt and $1,000 of equity. Now, Company B is also financing that debt and has to pay a 5% interest repayment. So let's now have a look at their financial results and an extract from their profit and loss. Now, both companies start with their earnings before interest and tax of $500. When we come down to looking at then now let's subtract the interest, of course, Company A has no interest because it doesn't have any debt. Whereas Company B has $50 of interest because it's for 5% on its $1,000 of debt. So we can see at this stage when we're considering our earnings before tax or our profit before tax that Company A is ahead. It's still got $500 and Company B is there with $450. So now if we consider the effect of taxation. Now, Company A pays $150 tax if we consider a tax rate of 30%, and that would leave it as a profit for the year, or retained profit for the year of $350. Now, Company B has a slightly reduced taxation because it can deduct the interest before it pays tax. So it has $135 of tax, which still means it's got a reduced profit compared to Company A, but its retained profit for the year is now $315. So at this stage, it still looks as if Company A is is returning better results in terms of its profitability. But now, if we have a look at the return on equity, we can see that company A has got a return on equity, which is its $350 over its $2,000 that is invested, of 17.5%. Not a bad return. But company B, because it's actually financed half of the company by debt rather than all by equity, it's now got a 31.5% return because it's got a much lower equity position in a sense. So you can see here by financing the organization and getting that mix right between debt and equity can improve the return for shareholders. But what are the risks though? So, what are some of the other considerations when we're looking at whether we're financed by debt and equity? Well, firstly, debt can be cheaper than equity. The bank often requires less interest than what an equity shareholder would demand in terms of returns from the organization. It also gets even more cost effective because interest is tax deductible, so it can reduce our tax bill. However, the real rub becomes debt is more risky than our equity. If we miss an interest payment, the bank will have a problem with that, and there'll be implications for the organization and could be severe implications. Whereas if we miss a dividend, yes, there are implications, but it doesn't mean that we'll be insolvent as an organization. Now, the other aspect of this is with debt, though, can have the benefit that if we issue more equity, more shares, we might dilute the ownership of the company. Whereas with debt, then we're not diluting that ownership. So it can have some ownership implications. This is where trying to get that balance right can be really important to try to improve our returns, but manage the risk of the organization and also the protecting the ownership of our current equity shareholders. Now, it is worth, just as a side note, noting that there are some forms of equity in dividends, there's a preference dividends that can be there that don't affect ownership control, but that will be a topic for another time. So if we have a look at an example of the debt to equity ratio for smart retail, we can see if we take the total debt of the organization, so this is the total borrowings that have been put in place with the organization, and divide that by the total of the shareholders' equity, we come up with a ratio of around about 24% in terms of its debt to equity ratio. Now, that's actually not too bad. People have different perceptions on this, and it can depend on the type of business and the ownership structure. But often, something below 50% is safer. Getting towards that 25% is quite a conservative organization that's using debt to actually generate some better returns, but still a very safe structure. Now, if we have a look at the debt ratio, this time we're going to be looking at our total liabilities divided by our total assets. So not just the borrowings, but all of our forms of credit in terms of our liabilities. Now, as we look at this for smart retail, we can see that in 2026, they have a ratio of about 41% or 0.41. Again, it's not too bad a ratio. It's not getting too high. We haven't got too much of the organization or our assets financed by debt within that aspect, meaning really the balance is then going to be financed by equity. And then we have the equity ratio. And often you would look at one or the other of these because the equity ratio is really just the inverse of the debt ratio that we've just looked at. But in this time, we're going to be having a look at our total shareholders' equity divided by our total assets. And we can see for smart retail, this is 0.59 or 59%, which is what you would expect if your debt ratio was 41%. So this should be the balance that was remaining for that. So here we're going to have a look at our interest coverage ratio. How well can we service our debt? And if we look at that for smart retail, we take their operating profit divided by their interest payment for the period. Now here are their EBIT divided by that interest payment means we have a interest coverage ratio of over 23.4, which is a pretty healthy coverage. It gives us some confidence they can meet those interest repayments year in, year out. Anything north of 10 is often considered to be pretty safe. Now, in terms of servicing the debt, a good ratio to look at is the debt service ratio, because this time we're not just taking into account the interest payments, we're also looking at are there any obligations to repay principal as well. And so here we're looking at our operating profits, and this time we're looking at our EBITDA, divided by the interest and principal repayments. And if we have a look at that for Smart Retail for this past year, that was only just north of 2. So that was fairly tight. But this is where we've got to understand how is are the borrowing structured for the organization? When are those principal repayments required? And actually, one other way of looking at this, because of course we need the cash available to make those payments, is a similar ratio, which actually looks at the debt service coverage ratio. And rather than looking at our operating profits, this time we're looking at our operating cash. Are we generating enough cash to make those repayments? So here we have considered some of those key ratios that we can use to evaluate a company's financial structure and how might that have changed over the years. Remember, with this ratio analysis, it is best looking over a number of periods, not just concentrating on one or two as we've done through the video here. But we've also understand how the capital structure in terms of its debt and its equity can affect shareholder performance, but also can affect the company risk profile. So thank you for joining with us today. If you've enjoyed the video, please remember to like and to subscribe to the channel. And you'll see some of the other videos within this series on ratio analysis. Plus, there'll be a number of other videos that are coming to the channel around understanding financial statements and making financial decisions around managing company performance. Thank you, and see you next time. If you're interested in learning more about financial statement analysis, have a look at the online course which is included in the comments below. It will take you through some of the steps we've covered off here, the introduction to the financial statement analysis, and through that we'll give you also a summary of Smart Retail's financial statements so that you can work through those numbers and go through the calculations. It will also go through each of the steps, the operating performance, profitability, and bring through a real world example. So we'll have a look at the real company and see how this translates in the real world. And it will also be supported by short activities at the end of each section so that you can test your knowledge and make sure you've got a good thorough understanding. Now, each of these steps and that we'll work through on the course will be supported by short little videos like what you've seen in this particular video. And at the end, it will also come down to a summary section to summarize what does it all mean, how do we use it, and what other information do we need to consider.